All right. Hey, everyone. Thanks for having me. Today, I want to go over personal finance. Let's see, click here. So the goals of this is really thinking back to what I wanted to learn about in medical school. I was preaching then. I'm still preaching. I wish medical schools and residencies would talk more about finances. I think it's something that's really unfortunate that med schools don't address, and some of it's understandable. They got a lot of medicine to teach you, and it's a big topic, just that alone, and teaching you to be a professional and the basic knowledge of medicine. But doctors go from living off of this kind of monopoly money to making a huge amount of money, being one of the top earners in the world. In comparison to the average population. So it's a really big deal, I think, and something that should be addressed so that people just don't throw this money away. So that's what I decided to talk about. We'll go through some of the financial terms, some strategies, some planning, hopefully some helpful tips for you as you enter into residency, or if you're already a resident going forward. So I don't have any financial background. I'm not a financial planner. I'm just a resident. I don't even have an MBA. I've never run a business before. Like, all this is just coming from what I've learned from books, podcasts, reading, YouTube. So take that with a grain of salt. I'm just trying to help you out as best I can with what I wish I knew. But this isn't official financial advice. Okay. So financial independence, two words that are just music to my ears. Love it. So what is it though? What is financial independence? Financial independence, you're independent from your finances. You're no longer dependent on your finances. You're no longer dependent on your income. So a lot of people think of it as, I can quote unquote retire. But I think there's a little bit more to it than that for doctors especially. I think it should be thought of more highly, because it's, to me, financial independence is freedom, and that comes down to why is it important, which we'll come back at the end of the talk. Technically speaking, financial independence, the basic rules, if you want to know, is 25 times your annual expenses. When you have that amount saved up in retirement accounts, you can technically retire. This is based on the 4% rule, which is you can withdraw from your savings account at a 4% rate and live off of that for the next 30, 40 years, adjusting every year for inflation, the economy going up and down. So that's where people get these general numbers. It's 25 times your annual expenses based on the 4% rule. How is it possible? How do you get there? That's where you kind of go down the rabbit hole. So we'll talk about a few strategies and things next. And people talk about this term of rich, and a lot of people, you'll hear that a lot through your training. Oh, you're going to be rich. You're a doctor. Oh, you're rich. And you have to remember, rich is, just because you make a lot of money doesn't mean you have a lot of money. Most of us have a lot of debt that we're going to have to pay off. Some of us will unfortunately spend a lot of money. So just because you make a lot of money doesn't mean you're rich. So keep that kind of term out of your vocabulary. All right, so what do you do next? Let's go through each one of these topics: budgeting, loans, retirement accounts, housing, personal finance, and then we'll end with kind of what is your why? Why is it important? So budgeting. Everyone has a budget. People hate this term in society for some reason, but everyone has a budget, whether you realize it or not. You are limited by the amount of money you have, and so you are on a budget. It's kind of like people saying, I don't want to diet, I don't like dieting. You're on a diet. It's just a matter of, are you eating junk all day or are you eating healthy? Regardless, it's a diet of some sort. So that's budgeting. Your budget, you have a budget. It's just a matter of taking control of it. So my hope for you is that you'll be proactive. Take charge of that budget. If you don't like to use that term, that's fine. You can use things like cash flow. Have a cash flow plan. How much money is coming in? how much money is going out, and where's it going. To take control of that and be proactive, I think you have to have a system in place. So back in the day, people wrote it down on a piece of paper, then it turned into Excel sheets. Nowadays, you have apps and websites and all kinds of options. I use Mint. It's an app and a website. It's free. You can put your loans in there, your savings accounts, your income, your bank accounts. You can create where the money is going and say, I spend on average $200 a month on gas. I spend this much on groceries, da, 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 da. And you have to look at your fixed expenses, rent, bills, and then take your average of your variable expenses. So your how much you spend on restaurants every month, or how much you save for vacations, that sort of thing. So you have to look back over the last few months, add that up, and start adjusting your budget and say, oh my gosh, I don't realize I spend $200 on Amazon every month. You don't realize where your money is going until you really start tracking it. And I think most people will be surprised on where their money actually goes at the end of the month. So Mint is really good. You Need a Budget is supposedly a really good one, but it costs money, so I don't do it. Dave Ramsey, I think, has one. So there's options out there. Use whatever system you want, but I think you should have a system in place and be proactive about it. And then if you have a significant other, a girlfriend, wife, a husband, try to include them. At some point, you're going to have to be on the same page about this, at least get in the same book about this. It's a touchy subject for a lot of couples. It's a big reason people end up getting divorces over money. So it's touchy. And people come from different backgrounds, different spending habits, but you have to start talking about it. So approach it sensitively, but include your significant other in it. Student loans. So again, I don't know everything about student loans. I don't know everything about all the different payment plans. But the average U.S. medical student graduates medical school with around $280,000 in loans, so it's a big deal. I'm at about 233 and climbing, so it affects a lot of people, and it's a significant amount of money. The general rules in residency is you pay as little towards your loans as possible, which sounds backwards initially. Most financial advisors that don't work with doctors would balk at that. Dave Ramsey doesn't like that. But if you listen to all the doctors that have blogs and stuff on finances, this is their general recommendations: to pay as little as you can during residency for a few reasons. One, you can't afford the standard 10-year plan in residency. It's going to be around $2,000, $2,500 a month. If you have the average amount of student loans, you literally can't afford it. So you're going to have to pick some sort of payment based on your income. And then two, most residents can't really afford to make a dent in their student loans. Like I said, my loans are climbing. I'm making my monthly payments, but it's still going up because I can't keep up with the interest rate that they have. But then the other biggest thing is you don't know exactly where you'll end up after residency. There's a thing called, if you haven't heard of it, public service loan forgiveness, where if you work for a non-for-profit, a governmental organization, a VA, a university, mostly falls under this. You can get your loans forgiven after working there for 10 years. The government will forgive them. So if you go into ENT, that's 5 years of residency. That's another year of fellowship. You're already 6 years into this possible forgiveness plan. Only need 4 more years potentially. So most people are like, oh, I'm going to private practice. You don't know for sure. Like, you want to keep this in your back pocket just in case something comes up when you end up working somewhere where you could get your loans forgiven. You don't want to throw this away. So that brings up the other point. The loans they are forgiving are direct federal loans. This isn't private loans. There's other kind of federal loans. These are direct federal loans. So you have to be careful what kind of loans you have. And then you'll also hear people talk about refinancing. They're talking about refinancing either after residency when you get a job as a private practitioner, or they're talking about refinancing your private loans. You do not refinance your direct federal loans because, again, you don't know where you'll end up after residency. You could end up somewhere where you could get your loans forgiven. So don't refinance those just yet. Wait. I think that's about all I wanted to say about that. Okay, so savings and retirement. Savings account. Basically, real physical banks are kind of a dead industry to me. You can have your own opinion on that, but I've gone completely online. Ally Bank has a really good savings account. American Express has a really good savings account. You get a higher interest rate. It's not much as it was, at least 1.5, 1.7%. So actually like $100 at the end of the year. But it's online. The customer service is really good. So you can decide where you want to put your money. But I think online savings accounts are really good. Retirement accounts and essentially what do you want to do with your extra money? And believe it or not, you could have extra money during residency. If you live in a place that's not very expensive like Buffalo, and if you're single, you don't have kids, like you could easily have extra money at the end of the month. What do you do with it? The common sense thing would say put it towards your loans, but again, you're not going to be able to make up for how much loans you have if you're the average person. So most people say start putting away. Make sure you have an emergency fund. An emergency fund is general recommendation is 3 to 6 months of your monthly expenses you want to have saved away, just in case anything ever happens. It's good, you know, we're not going to get fired normally during residency or lose our job, but it's good to have some sort of emergency fund if your car breaks down, if you own a house, if your roof breaks, whatever. Retirement accounts. This is a good thing, I think, to get started on during residency. You're not going to get rich during residency, but it's a good thing to start working on habits and learn about retirement accounts, where to use them, how to use them, which ones to use, that sort of thing. So it's almost like a practice to me for when you get out and the money really starts mattering. So overview of retirement accounts. You can think of accounts as suitcases. You know, when you travel, you got a big suitcases. You can have different size suitcases, different kinds of suitcases. Those are retirement accounts. The investments are like the clothes you put into the suitcases. You can put most kind of clothes into any kind of suitcase. So you can think of it that different way. So accounts are like your 401k, your Roth IRA, traditional IRA, things like that. Investments are your index funds, your individual stocks, bond, gold, real estate accounts, that sort of thing are your investments that you can put into these suitcases. Then within accounts, you have pre-tax accounts and after-tax accounts. So the pre-tax accounts, the money goes straight from your employer into that retirement account. Most people think is traditionally the 401k is the classic example of this. So that money doesn't get taxed until you pull it out in retirement. The benefit of this is huge because if you're making $400,000 as a doctor, you don't want to get taxed at that. You want to get taxed at your retirement income, which will be whatever you're pulling out of your retirement accounts, which is, you know, $80,000. So the tax rate is a lot less. So that's why people love those. If that's a possibility for you in residency, most places is in it. Use it if it is. Most places that isn't an option. So during residency, then the next thing most people go to is a Roth IRA, which is an after tax. So you get your money into your online savings account and you say, oh, I have an extra $200 every month. What should I do with it? Open a Roth IRA and you can put it in there. You can put up to $6,000 a year into a Roth IRA. They're very good accounts because they don't get taxed again. So after you put that money in, it's not going to get taxed when you pull it out in retirement. You can pull it out early sometimes, where some accounts have age limits. So people love Roth IRAs, especially during residency. Let me see everything I want to say there. Yeah. Okay. Okay. So disability and term life. This is big letters, bolded, because this is very important. If you are dependent on your income, which most people are, unless you're married to someone that has a good job during residency, if you're dependent on your income, you should have disability insurance. Some residencies will provide it, but it won't be very, very much. Like Buffalo, it's great that they provide it to us. But if I got disabled, they give me like $1,500 a month. It's not enough for my family to live off of. So most people need a separate disability insurance, and most people should get it if you're dependent on your income, whether you're single, married, or whatever. If you're dependent on your income, you should get disability insurance. You want the buzzwords you're looking for when you go to look for this is own occupation, which means if you get disabled and you can't operate as an ENT, you can still work and you'll get your full disability payout. So own occupation and gender neutral, especially if you're a female, because insurance companies like to mess around and give females a lesser deal, which is not right. So you want gender neutral, own occupation, disability insurance. If anyone else is dependent on your income, a wife, kids, you should have term life, 100%. So some, again, residencies, they provided it to us here at Buffalo, but it's only like $200,000. It's not really enough for my wife and kid to live off of if I were to die. But you can get a $1 million policy for $20 a month. So it's pretty easy and cheap to get it, especially while we're young and healthy. So both of those should be something you consider during residency. Housing. So the general rule is you don't buy a house during residency. Now, I am 100% a hypocrite on this right now because I bought a house. So the general rule stands because most people consider you don't start making money off your house until you've owned it for more than 5 years. So obviously residency is like right on the fence of that mark. If you live in a cheap place, like Buffalo's pretty good, has a good housing market, you can hopefully get away with it. I'll find out in 2 years if I did. But I also broke the other rule, which is you should only buy a house that's 2 times your income, which would be like $100,000 house for me. I bought a $200,000 house. So another rule I broke. But again, hopefully I get away with it. The other reason this is such a big deal, and I think this is really the bigger part that I've experienced so far, is that it's a lot of your time. Like it's not just the money aspect, but residency takes up a lot of your time and energy, and so does owning a house. So I've enjoyed it a lot of ways. I've learned a lot. I like doing projects. I like making things and woodworking and all that, but it still has taken up a lot of my time to where I have to choose, do I do this on the house, study for ENT, or hang out with my family? It's like, the working on the house is not really one I want to choose over either one of those things a lot of times. So it's not so as much as it is the money thing and the risk financially of buying a house during residency. It's also the time you have to think about. Okay, having a financial plan. So I think your goal should be throughout residency, if you don't know a lot about finances, to learn about it. That's kind of what I'm doing. I've learned a lot over these last 3 years. There's tons of podcasts, blogs, books that you can read and listen to while you're working out, headed into cutting the grass in the house that you bought, whatever it might be. There's a lot of resources now too, more so than there used to be. A lot of people have heard of the White Coat Investor, which is where a lot of the information I'm repeating is from. He's very good. There's a series of them now, these doctors that are really into finances, and they've started blogs or podcasts or written books. So there's a lot of resources out there. White Coat Investor, just going there, you can find some of these resources, or you can use his stuff. Money Meets Medicine is another really good podcast I listen to. Physician on Fire is another blog. So there's all these different options now. So find one you like or a few you like and start delving into it, I think. If you don't want to, if you have no interest, then at least start exploring financial advisors and getting one you might like towards the end of your residency. So like 5th year, start reaching out to people, find one that you can work with. The buzzwords on finding a financial advisor that you want. Fiduciary. That means they have signed a paper where they're morally obligated to provide you sound advice. You know, they're not legally obligated to, but they're morally, technically supposed to, is if they're a fiduciary. So you should at least have that. And then flat fee only advisors. That means that you pay a fee and that's it. They're not going to charge you 2% on every time you make some money. You don't want that. That's again, like an older model. I think it should be fiduciary, flat fee only advisors. That's what you want to look for. So have a financial plan by your end of residency so you can go into your job and kind of stick to something for the first 12 months. So you don't go out and buy a car and buy a house that you can't afford and all this stuff. So you have a set plan, and people are more likely to stick to things when they have a set plan. Okay, so what is your why? Like, why is this important to you? Some people, if you start talking about money, like, again, people don't really like to talk about money. It makes them uncomfortable. A lot of people don't know a lot about money, so they don't feel comfortable talking about it. They don't want to be involved in their private lives, whatever it is. But when you start talking about it or start learning about it, people kind of might label you as like all you care about is money. But it's not so much about that, for me at least. It's not about the materialistic stuff. To me, money is freedom. Money is time. Like if you're not worried about money, you can, it changes the way you work, changes the hours you put into your work. You can go on vacations. You don't know what your life will look like when you're 45, 50, 60 years old. You don't want to be tied down to, I have to work, I have to make this much money because I can't afford my lifestyle, I can't afford this. Now my kid is sick, my wife is sick, but I have to work my butt off because I'm not in a good financial place. Like you want to have freedom, not in your everyday life, but then years down the road, you don't know what life holds. So to me, being sound financially is just being prepared for what might come in the future and wanting to have that flexibility. You don't know if at 45 you're like, I'm done with this job, I want to go part-time, or I really want to go work for a non-for-profit or go work, in Guatemala or someone. You don't know what you're going to want. And so you want to, I think, have flexibility. And I think that's why money is so important, because it provides that. It provides you that freedom, that flexibility, that time with your family, not just in your present day, but in your future as well. So good things to kind of help you think about what's important to you. What is your why, and why is this important? Are they kinder questions? They're kind of get the conversation started for you or your spouse. And there's a 3 set of questions. You can look it up, but it's basically like, what would you do if you didn't have to work anymore? And, those kinds of questions. So I think that this is kind of the most important part of this talk, is figuring out why you work, why is things important to you, and then you can kind of tailor your financial plan and your goals to that. That's all I got. I hope that was helpful. I hope that's a nice little introduction for you, and helps you guys kind of know where you're at in your financial literacy. Any questions?
I have a question, Sam. Thank you so much for that lecture. Question about Roth IRAs, in terms of like, what's like a good interest rate when you're looking at Roth IRAs?
So that's where it comes down to the accounts and investments. So the Roth IRA is just the account. It's just a suitcase. You can open one on Vanguard or Fidelity, are 2 places that are very user-friendly and cheap. They don't cost anything to open it. And they provide a wide range of investments. The clothing you can put into the suitcase. So in general, once you open your Roth IRA, sometimes there's like a limit of how much, like you might have to have $1,000 before you can start investing or something like that. But you want to look for an index fund and something that's passively managed. So passively managed means it's just like algorithms and computers, and no one's actively managing it. Like a person is an active managed fund. Whenever it's actively managed, they're taking out a higher percentage of the money you're making. And years of statistics, centuries have shown that actively managed funds are not better than passively managed funds. So there's really not often a reason to ever get an actively managed fund. So you want to have a passively managed fund. You can just get like a cheap index fund. The percentages are usually low, like 1% or lower, like on Vanguard or Fidelity, and that's what you're looking for, is something that's like a really low cost to put into your Roth IRA.
And then just to be clear, so like let's say you make $50,000 in 1 year. If you put $6,000 away in your Roth IRA, at the end of the year you're going to be taxed on $44,000. Like that $6,000 isn't going to be taxed as part of your like income for that year, or am I thinking about this wrong?
So it's not going to be taxed. Yeah, that money's already been taxed when it's got taxed as income and came to you.
Oh, gotcha.
So the money
okay.
that into your savings accounts, it's already been taxed by the government. So once you put in the Roth IRA, it's not going to get taxed again.
Okay, cool. Thank you.
Yeah.
I got a question about something I've been wondering for a while. What do you think about leasing versus buying cars or a car?
Yeah. So I think you should buy. And again, this is probably a rule that I broke. It's definitely a rule that I broke. Before I really knew more about finances, I bought a very nice Jeep Wrangler, and it's paid off. My wife had a nice job at the time. She's a lawyer, so we could afford it. But again, it wasn't really probably the right choice. I think the best advice is to buy like a $5,000 car, like something you can buy with cash. All you're trying to do is get through residency or get through med school. Like, you're not going to be able to afford a really nice car most of the time. You can get really cheap leasing and stuff, but I think people kind of underestimate how long cars can last. Like before my Wrangler, I had a Nissan Maxima from 1998 that had 250,000 miles on it. And I bought it for like $2,000, and it lasted me 6 years. So I think people underestimate how long cars can last. So I think my advice, although I didn't stick to it, would be to buy like a $5,000 car that you can pay cash for.
Gotcha. Thanks.
Hi, Sam. I actually also have a question. Thank you for your presentation. If your medical school pays for long-term disability insurance while you're a student, and you have the option to take over payments and keep it as like a resident and later on, what are your opinions on keeping it versus like shopping around?
Most of the time you don't want to keep it. So there's only 6 insurance companies in the country that provide own occupation insurance. So most of the time, the disability insurance you're offered in med school or residency is like some random insurance company that the university has a deal with type thing. So you'd have to look at the details of what the details of that disability insurance are to see what it actually says. Because there's only 6 out there that'll do it. And most of the time, if you go to an independent agent, that's where you're going to get your best deal. Because if you go to an agent, you don't have to pay them. They will shop you around to the 6 different insurance companies, and they'll all send you a rate. And so that's how you get the best rate. Most of the time, you can't get that from just continuing something from med school, but you'd have to look to know for sure. But that's, I think the best way to do it is to find an independent agent. They'll shop you around. You don't have to pay them. Then you can pick the best rate and go with that insurance company.
Awesome. Thank you.